Hello everyone, this is Orhan Erdem. In this video, I'm going to talk about fixed income securities, which is another name for bonds. Companies raise capital in two different forms, debt and equity. In this lecture, I will explore the debt. In the coming lectures, we will turn our attention to equities. The main instrument of debt financing is bond. Let's explore what a bond is and how it might benefit your investment portfolio. Companies or governments issue bonds to borrow from investors who are paid interest in return. A bond is a long-term loan given to a borrower, like a company or government. Under a bond contract, the borrower agrees to make payments of interest and principal on specific dates to the holders of the bond. Bondholders are lenders, not owners. So bond markets determine the interest rate between lending and borrowing, and fixed income market is the biggest market in the world. On October 2020, there were over $131 trillion worth of bonds in existence worldwide. This is bigger than world GDP, which is $88 trillion. It also towers over the world stock market, which is worth only $92 trillion. So this graph shows the historical performance of world stock market capitalization. So the next question might be who issues bonds? Bonds are issued by corporations and government agencies that are looking for long-term debt capital. So this graph shows the 10-year Treasury constant maturity rate, which is the yield government bonds are offering their investors. It's not only government agencies, but the corporations. But in this graph, you only see the government bonds yields in 10 years. So as a general rule of thumb, it's not always true, but a general rule of thumb, the interest rates, the yields of the bonds, they generally go down during the recessions. As you can see in this graph, the shaded areas indicates the recessions. The recessions, the interest rates generally go down. We also can say that during the time of fear, which is measured by this white line in this graph, it's called VIX index. When VIX index is high, it means generally that there's fear, there's growing fear in the market. For example, these days are the high fearful days in the market. So when there's high fear, people generally fled to government bonds, and that's why the interest rate, the yields of the government bonds, which is shown by the orange line, they go down. Okay, so these are the yields of government bonds. Even though the corporate and government bond rates tend to move together, corporate bond rates are generally higher because they are perceived riskier. So the difference between corporate and government bond rates is called yield spread or credit spread. As I mentioned before, bonds are issued by corporations and governments who are looking for long-term debt capital. Let's now take a look at different companies who are looking to raise funds. So I'm going to show you from Bloomberg screen different corporations. In this graph, you see Apple and their way of raising funds. So there are two main ways of raising funds, as I told you before, equities and bonds. Okay, as you can see from this graph, this is the CAST function in Bloomberg. As you can see from this graph, Apple generally preferred to raise funds in equity markets. Okay, so the right column shows equity market, the left column shows the bond market. So this is how much they raised from bonds, and this is how much they raised from equity markets, which is mainly the stock market. Now let's take a look at different company, Boeing. This is how Boeing raised funds. The right column shows the equity markets, left column shows the bond market. As you can see, they are more or less equal. So Boeing kind of raised funds like half-half, more or less 50% from bond markets and 50% from equity markets, which is not the case for Apple. Apple mostly preferred equity markets. So why should we invest in bonds? Well, there are a couple of reasons. The main reason is they are low-risk investments and they provide diversification opportunities for investors. This graph shows us the comparative performance of stocks and bonds from 1975 to 2018. As you can see, the white line, which represents the yields of government bonds, they are more stable less risky and less volatile compared to stock markets. So the next question is, why do government issue bonds? To answer this question, I'm going to use a Bloomberg screen with BIBUDG function. This function shows us the US federal budget. And then from this screen, let's click on surplus and deficit from here. So you would see this graph. So in this graph, orange line represents the expenditure of government, so government expenditure, and the white line represents the tax receipts. When orange line is above the white line, the government is spending beyond its means, so it needs to borrow to fill the gap. Here, for example, so the orange line is above the white line, so the expenditures are higher than the tax receipts. The panel below this graph here shows us the difference. So when the bars here, when the columns here are red, this means budget deficits. So the tax receipts are lower than the government expenditures. And the green lines here represents the budget surplus, which happened around 2000. So when there is budget deficit, meaning the government expenditure higher than tax receipts, the government needs to fill the gap by issuing bonds. Now let's see who holds US debt securities. This is debt function. When you write debt here, and then hit enter, you will see sovereign debt ownership of US securities pie chart. So this pie chart shows us the main holders of US debt securities. As you can see from the panel to the right, so Federal Reserve is holding $4.2 trillion of debt. And then Japan is 1.2, China is $1 trillion, United Kingdom is $400 billion, etc., etc. Before going to the essential features of bond, let's talk about the risks inherent in bonds. The first one is interest rate risk. It's the chance that changes in interest rates will negatively affect the bond value, as we will see in a moment, that when interest rates go up, the price of the bonds, they go down. The second one is purchasing power risk. It's the chance that bond yields will lag behind inflation rates. So inflation erodes the purchasing power of money. When inflation goes up, the yield the investors are going to get from the bonds might lag behind inflation rate. So in reality, you might get negative returns. Third one is business and financial risks. This is the risk that the issuer of the bond will default on interest or principal. This is also called a default risk. The other one is liquidity risk. This is the risk that is associated with selling the bond at a reasonable price. And the last one is call risk. This is the risk that a bond will be called before its scheduled maturity date. Okay, this is the end of the first part. In the second part, I'm going to show you how to value bonds.